Hello students, welcome to my class. This is Professor Vincent Osaya and this is the second part of the presentation of chapter 18, Revenue Recognition. We talked about the general principles or guidelines in recognizing revenue in the first part. And we left off by talking about the revenue recognition alternatives. We also established the fact that when we talk about revenue recognition, we are also talking about accounting for or recording revenue. Those three terms are used interchangeably. So here we have three alternatives. We have some situations whereby revenues are recognized at the point of sale. And we have some situations where revenue are recognized or recorded before delivery. And we have some situations whereby revenues are recognized after delivery. So the first thing we are going to do in this session is talk about situation or circumstances where revenues are being recognized at point of sale and some of the complexity in the implementation in terms of some situations. So let's take a look at the second objective. We're going to talk about accounting issues for revenue recognition at point of sale. Now, usually companies meet the two requirements to recognize revenue. We talked about that in part one. Number one is the revenue has to be realized or realizable, and number two, the revenue has to be earned. We expatiated that in part one. Now, however, we have some situations whereby the recognition of revenue is a little bit more complex than the ordinary situation whereby we sell a product to a customer and we recognize revenue right away. So here are some implementation problems relative to recognizing revenue at point of sale. Now we have 7 problems here, or 7 situations that pose challenge. Number one, sales with discount, sales with right of return, sales with buyback, bill and hold sales, principal agent relationship, trade loading and channel, stuffing, multiple delivery arrangements. So let's take a look at the first example of revenue recognition at point of sale, and that is sales with discount. So this is trade discounts, or what we call volume rebate, a situation whereby the seller give the buyer the incentive to buy as much as possible and you have a discount. Then number two, if payment is delayed, an interest factor has to be taken into consideration. What do we mean by that? So for example, we buy equipment or we sell equipment to a buyer and the buyer promised to pay us $50,000 in 3 years. Actually, because of that time period, we need to make sure that we take into consideration the interest component of that $50,000. So the selling price of what we are selling to this customer is not $50,000 because interest has to be taken into consideration because of the period of time. So that is the second bullet. Now, let's take a look at now that we have talked about the rules, let's take a look at the application of sales with discount. So here's the fact. As company has an arrangement with its customer that it will provide a 3% volume discount to its customers if they purchase at least $2 million of its product during the calendar year. On March 31st, 2014, S has made sales of $700,000 to a customer. In the previous 2 years, S sold over $3 million to this customer in the period April 1st through December 31st. S made the following entry on March 31st. So here we are assuming that the buyer is going to meet this requirement. So we debit accounts receivable for $679 and credit sales revenue for $679. Remember, 3% discount. So 97% of $700,000 is $679, or 3% of $700,000 is $21,000. $21,000 from $700,000 will give you $679,000. Now, let's take a look at what happened. The customer actually met the discount threshold, which is they have to buy this much in order for them to take advantage of the discount. So look at the journal entry. The customer paid us $679,000 in cash, and we credit accounts receivable for $679, right? So case closed. Now, Let's take a look at a situation whereby the customer failed to meet the discount threshold. In other words, the customer did not buy enough as required. So guess what happened? The customer is now obligated to pay us 700,000 without taking advantage of the 3% discount. So we receive 700,000, we add the seller, and we credit accounts receivable for 679, and we credit sales discount for retail for 21,000. That becomes additional revenue for us. So that is example 1 of point of sale. So let's take a look at example 2 of point of sale, and that is sales with right of return. What does that mean? Listen to this very carefully. So that is a situation whereby we, the seller, we sell goods to our customers, and we say to our customers, you have the right to return these goods to us for whatever reason. So when we have that kind of arrangement with our customers, then we are taking the risk of ownership of those goods that we sold our customer, because if they are not able to sell it for whatever reason, they are going to return the goods back to us. So in such circumstance, we have 3 alternate revenue recognition methods that are available in dealing with that kind of situation. Number 1, we don't even record a sale until all return privileges have been expired. In other words, there are some conditions there. If the condition expires, then the buyer is stuck. The buyer has to buy them. So that's number 1. Don't record sales at all. Number 2, we record the sale and make provision for X amount of dollars that might be returned. And number 3, we record the sale and account for the returns as they occur. So those are the 3 alternate revenue recognition methods. Now, listen to this very carefully. Here are 6 conditions that have to be met in order for you to recognize or record revenue. These 6 conditions are specifically related to sales with right of return, okay, which is the second example of point of sale. Now, go through these 6 conditions yourself, okay, and we are going to take a look at the implementation. No, let us go back and take a look at one of the 6 conditions. The seller's price to the buyer is substantially fixed or determinable at the date of sale. That means the price is not fuzzy. We know for sure exactly what the price is. So again, like I said, go through all the 6 definitions, excuse me, the 6 conditions relative to sales with right of return. So let's take a look at the application of those 6 conditions. Here at the first, P company is in the beta testing stage for a new laser equipment. Let me summarize the situation. Listen to this carefully. We sold the equipment to the hospital and said to the hospital, okay, you can bring back the equipment if they don't work out for whatever reason, and we'll reimburse you for a period of 9 months. All right? Now, guess what? The question is, when should we recognize the revenue for the sale of the new laser equipment? If we are telling the hospital that they can return it in full for full reimbursement for 9 months period, clearly the hospital has the right to rescind the purchase for a reason specified in the contract. So therefore, the question is, how much or when should we recognize revenue? In this situation, we should not recognize revenue at the point of delivery, because the risk of ownership is still basically on us, because the hospital can return it within 9 months period. Now, let's take a look at another example relative to sales with right to return. Here, this company sold $300,000 of laser jet, and the company, watch out this time, assuming that we are the seller, this time we are retaining only insignificant risk of ownership. In other words, we are not taking too much risk in terms of the equipment being returned to us. In such circumstance, guess what? We recognize revenue. Unlike the previous example that we just illustrated, whereby we ask the hospital to return those equipment with full reimbursement within 9 months period. So this time we recognize the revenue. Accounts receivable is debited for 300,000. Sales revenue is credited for 300,000. Now, the customer returned 10,000 of the 300,000. So we debit sales returns and allowances, which is a contra account to sales. So that decreases sales indirectly, and accounts receivable is credited. So the customer owes us less than $10,000 less. Now, take a look at what happened. At the end of the year, we are going to make provision for X amount of sales that might not be. We are going to make provision for X amount of sales that might not be that might be returned. So we take the $10,000 returns into consideration. So we debit sales returns and allowances for 11,600 and credit allowance for sales returns and allowances for the same amount. So moving along, let's take a look at the third example of point of sale. This time, sales with buyback. What are we talking about here? Here's a situation whereby we, the seller, we said to the customers and we said to the customer, okay, we are going to buy back whatever you are not able to sell. So in such circumstance, the seller, that is with the seller, we are retaining significant risk of ownership. So let's take a look at the example here. In this example, here is the key. The company agrees to repurchase the equipment at the end of 2 years at its fair market value, and the buyer is given the right to use the equipment over that period of time without any restrictions. So in this case, we are going to recognize the revenue because we are anticipating of buying back the equipment only at its first value at the end of the specified time period. So in such circumstance, we debit cash for 135,000 and credit sales revenue for 135,000. We debit cost of goods sold for 115 and credit inventory for 115. I want to bring to your attention here that we made 2 entries, but we only have what? 1 transaction. So remember the perpetual inventory system, whereby we keep track of inventory on a continuous basis. So here, the 2 transactions, 1 transaction account for the sales, the other transaction recognize the cost of goods sold and the reduction in inventory. Now, let's take a look at the 4th example of recognition of revenue at point of sale, and that is bill and hold sales. So what are we talking about here? This is a situation whereby, just take a look at an example, assuming that this is a Home Depot. You go to Home Depot to buy an equipment, stove, because you are opening a restaurant, and you bought 10 stoves, but you said to Home Depot, well, I really don't have a space for this 10 stove right now. The stove needs to stay right here, but we are going to make full payment and we are going to pick up later. In such circumstance, Home Depot does not have any risk because you already paid for it. They are just holding on to those stoves in their storage space. So that is bill and hold example.